Big tech and artificial intelligence drove the market in 2025. Now, Barron's is out with our stock picks for 2026. Barron's associate editor Andrew Bary compiled the list and has the deep dive on which stocks stood out and why. Andrew, I have it on good authority that when Andy Williams sang "It's the Most Wonderful Time of the Year," he was referring to Andrew Bary's stock picks. Before we dive in, give us the big picture view. What's the macro driver behind your thinking this year?
Well, it's been a growth-oriented market, but we take a more value-oriented bent with our picks. We also pick some laggard growth stocks, and nearly all the stocks that we picked were behind the market this year. So we think there will be some catch-up for these in 2026.
In case there's anybody who doesn't know why, let's remind viewers as to why they ought to listen to you. How did you do in 2025?
Well, we had a very good year this year. I mean, our 10 picks were up on average of about 28%, which is more than 10 percentage points better than the S&P 500. So, but you know, we've had some not so great years, including 2024. We're hoping that next year is more like this one.
All right, so you said you looked at some of the stocks that didn't do so well in 2025. Let's start with a big one, Disney, which was flat over the course of the year.
Yeah, I mean, Disney's got a great franchise. The stocks, as you said, is about flat this year. Earnings growth should be pretty good next year at about 10%. Also in 2027, they're guiding to that. And the stock is, I think, in a pretty good position right now. I think the takeover battle for Warner Brothers kind of highlights, I think, the value in Disney, particularly the parks business.
You know, you mentioned the park business, Andrew. I was just reading that actually some people have priced out the cost of a trip to Disney Tokyo, and it's actually cheaper than going to Disney World in Orlando. These parks have really been expensive. Do you think that that's going to be a big concern in 2026?
Well, I mean, investors are definitely worried about that, and the parks business did slow down a little bit in the third quarter, and it can cost $200 a day per person to go to Disney World. So it's a big nut for a lot of American families, but it's still doing pretty well, the parks business, and even the threat from the new Universal theme park in Orlando doesn't seem to be dampening visitor interest in going to Disney World.
And hey, it was cheaper for people to fly overseas to see Taylor Swift, and she's still doing just fine.
So Andrew, I know you like your laggards, but Amazon, this was the worst of the Magnificent Seven this past year. What's going on there?
Well, I mean, Amazon has been, of course, a huge long-term winner. The stock was a laggard in 2025, and I think the reasons have to do with some concern about their heavy capital spending and whether or not they're going to be as big a beneficiary from AI as some of the other Mag 7 stocks. But here you've got two phenomenal franchises, the leading e-commerce business in the United States with over about a 40% market share, and the leading player in cloud computing in Amazon Web Services. And it's trading pretty reasonably between 25 and 30 times next year's earnings, which is below Walmart, below Costco, for a company that I think is probably superior to both of them.
You know, Andrew, let's talk a little bit about healthcare, because I think this is a sector that's proved a little challenging for folks to try to pick winners here. Your bet is on Bristol Myers. Why?
Well, you know, it's been a kind of a story of haves and have-nots in the drug sector. The big have has been Eli Lilly, which has been the big beneficiary of the boom in the GLP-1 diet drugs. Bristol Myers has been in the have-not category along with Pfizer and Merck, but I think it could be a turnaround candidate in 2026. It's got a cheap valuation, under 10 times earnings, nearly a 5% dividend yield, and a pipeline that may be underappreciated right now.
So Andrew, I'm not a betting man, but if I were a betting man and I want to take a flyer on a gambling stock, you think I should take it on Flutter Entertainment? Yeah,
I mean, Flutter is not well known to U.S. investors, but it's the leading online gambling company in the world that owns FanDuel, which is the #1 sports online betting company in the United States, with about a 40% plus share. It's actually bigger than DraftKings, and there's been concern recently about prediction markets and how the growth in prediction markets like Kalshi and Polymarket may cut into the online sports gambling business, but I don't think that's going to happen. You can do things with on online sports gambling that you can't do in prediction markets, including parlays, which are multiple bets, and also what they call prop bets, which are not based on the outcome of a game, such as whether the Chiefs quarterback Patrick Mahomes is going to throw for 300 or 400 yards in a game.
Well, that's a bet I'm going to take, because he's going to throw for 0 yards in the next game because he just blew out his ACL.
This will be the first time since 2014 that the Chiefs didn't make the playoffs.
Yeah, and so, I mean, Flutter's trading for about 20 times next year's earnings, and it's growing earnings about 40% a year, so it's pretty cheap relative to its growth rate.
I'm not going to try to best Ben about the puns that I can put in my question, but let's talk financials, because I think, that's another interesting sector. You have Visa, which is kind of an interesting one, especially because we've been hearing so much about this two-speed economy and the K-shaped economy. Why do you think Visa is really the winner here?
Well, I mean, Visa is a classic compounder in terms of generating consistent growth year in and year out. It and MasterCard dominate the payments business, and that doesn't look like it's going to change despite the challenge from buy now, pay later, stable coins, and it's trading for a pretty reasonable valuation given its growth rate, which is probably in the low double digits every year.
Well, at least one more from you, and that is Fairfax Financial. Not a name a lot of people might be familiar with, but they may be in the future.
Well, Fairfax is a quote mini Berkshire Hathaway. It's got a $40 billion market cap against Berkshire's $1 trillion. It's growing faster, has a very strong management led by the chairman and founder, Prem Watsa. It's up in Canada. You have to buy the stock there. It has some lightly traded U.S. shares, and it's well run. It's got some very good Indian investments. So it's actually an interesting play on India, as well as the property and casualty insurance business. A low valuation, under 10 times next year's earnings.
But if they can, you recommend investors in America use the Toronto Stock Exchange, not the American shares?
Yeah, I mean, I think if you can invest in Canada, I think that's a better way to do it. There's more liquidity in the Canadian shares than in the five-letter ticker U.S. shares.
All righty, we're going to keep you honest, Andrew, and see how you do in 2026. Thanks for the picks.